What happens to the world when the biggest economy faces a recession? If the US enters a downturn, which countries are most at risk of economic collapse? Stay tuned as we reveal the 10 nations most likely to crumble under the pressure and why their fate is so closely tied to America's economy. The United States plays a central role in the global economy, driving international trade, investment, and financial stability. If the US were to enter a significant recession, the ripple effects would impact countries that heavily rely on American markets, investments, and remittances. In this video, we'll examine 10 nations whose economies are most vulnerable, analyzing factors like trade dependence, foreign investment, and economic structure. Let's dive into the countdown. Number 10. Mexico shares a long border and a deep economic relationship with the US, making it highly susceptible to any American downturn. With over 80% of its exports going to the US, the Mexican economy is heavily reliant on trade. Industries like automobiles, electronics, and agriculture would suffer significant losses if demand from the US decreases. Beyond trade, remittances from Mexican workers in the US are a vital lifeline for millions of families, accounting for nearly 4% of the country's GDP. A drop in these funds would severely impact rural areas, where households often depend entirely on these inflows. Furthermore, tourism from American visitors plays a crucial role in Mexico's economy, which would also take a hit during a recession. Mexico's government would struggle to stabilize its currency and prevent inflation under these circumstances. Social unrest could rise as unemployment and poverty increase across the nation. The ripple effects would further strain public services and lead to budget cuts in critical sectors like healthcare and education. While Mexico has shown resilience in past economic crises, its heavy dependence on the US means a recession there would leave a lasting impact. Number 9. Canada's economic relationship with the US is among the closest in the world, with trade worth billions of dollars flowing between the two nations daily. More than 75% of Canadian exports, including oil, lumber, and manufactured goods, are destined for the US. A slowdown in American consumer spending or industrial activity would directly hit these sectors, leading to factory closures and job losses. Additionally, Canada's energy sector, a major driver of its economy, would face reduced demand as the US cuts back on imports. The financial markets in both countries are tightly interlinked, so a US downturn would also shake Canadian investors' confidence. Furthermore, tourism from the US, which fuels many local economies in Canada, would decrease dramatically. The housing market could feel the pinch as interest rates rise, making mortgages less affordable for Canadians already grappling with high debt levels. Social programs and government budgets might face cuts as revenue from exports and taxes declines. Despite its robust banking system, Canada's economy would face considerable stress if its largest trading partner falters. Historically, Canada has weathered US recessions better than most, but its deep integration with the American market leaves it highly exposed to any downturn. Number 8. The United States remains China's largest trading partner, importing over $500 billion worth of goods annually. If US consumer demand declines, China's export-heavy economy would face factory closures and rising unemployment in key manufacturing regions. Beyond trade, US investment plays a significant role in China's economic growth, particularly in the tech and industrial sectors. A slowdown in investment flows would disrupt ongoing projects and innovation. Moreover, as the world's largest holder of US debt, any instability in the American economy could impact China's financial reserves and currency stability. The ripple effect on global markets would also reduce demand from other countries, compounding China's economic challenges. Social tensions might rise as unemployment spreads among young workers and rural communities. Despite China's efforts to diversify its economy, its heavy reliance on exports and US ties would make a recession there profoundly destabilizing. Number 7. India's fast-growing economy might seem resilient, but it is not immune to the effects of a US recession. The country's IT sector, a major contributor to its GDP, heavily relies on American companies for outsourcing and tech contracts. A decline in demand from the US would directly impact India's software and services exports, leading to layoffs in the tech industry. Furthermore, remittances from Indian workers in the US, which contribute billions of dollars annually to India's economy, would likely decrease. This would affect household incomes in rural areas where these funds are often a primary source of livelihood. Trade relations between India and the US, particularly in sectors like textiles, pharmaceuticals, and engineering goods, would also face disruptions. The reduced demand would hurt small and medium enterprises, which form the backbone of India's industrial economy. While India's domestic market offers some cushion, the interconnected nature of the global economy would amplify the challenges. The government would likely need to intervene with fiscal measures to prevent a deeper slowdown, adding strain to public resources. Number 6. The Philippines relies heavily on its economic ties with the US, especially in remittances and business outsourcing. Remittances from overseas Filipino workers in the US contribute over 10% of the country's GDP, making it a critical source of income for millions of families. A US recession would reduce these inflows, leading to widespread financial hardship across rural and urban areas. Additionally, the country's business process outsourcing (BPO) industry, which employs hundreds of thousands, heavily depends on American companies. A decline in outsourcing contracts would result in significant job losses and lower tax revenue. The Philippine export sector, which includes electronics and agricultural products, also relies on the U.S. as a key market. A drop in demand would shrink export earnings, further straining the economy. Rising unemployment would likely lead to increased social unrest, forcing the government to divert resources to manage public dissatisfaction. Number 5. Vietnam has rapidly emerged as a manufacturing hub, with its economy heavily dependent on exports to the U.S., its largest trading partner. Key sectors such as textiles, electronics, and furniture manufacturing would be directly affected by reduced American consumer demand. Factory closures and layoffs would likely ripple across Vietnam's industrial zones, leading to rising unemployment and social unrest. In addition to exports, Vietnam has benefited from foreign direct investment, FDI, much of it linked to US-based companies. A recession in the US could slow or halt new investments, disrupting Vietnam's growth trajectory. Moreover, the Vietnamese economy has seen significant inflows of remittances from overseas workers, particularly those in the U.S. A decline in these remittances would further strain rural economies that rely on these funds. The government would face mounting pressure to stimulate domestic demand and provide support to affected industries, but limited fiscal resources might constrain its response. Number 4. Germany, as Europe's largest economy, is deeply integrated into the global economic system and heavily dependent on exports, especially to the U.S. Major industries like automotive, machinery, and chemicals rely on American demand for their high-quality goods. A U.S. recession would reduce this demand, leading to factory slowdowns and job cuts in Germany's industrial sector. Beyond exports, Germany's financial sector is intertwined with the U.S., with investments and banking operations that would feel the ripple effects of any downturn. As a hub for global trade, reduced economic activity in the U.S. would also slow Germany's supply chains and logistics networks. Furthermore, American tourists significantly contribute to Germany's travel and hospitality industry, and a decrease in tourism would impact local economies. Germany's government, already grappling with energy transition challenges, would face additional pressure to stimulate the economy. While Germany's strong fiscal position offers some room for intervention, the interconnected nature of global markets makes it highly vulnerable to prolonged U.S. economic instability. Social programs and welfare spending might come under strain as unemployment rises, potentially leading to social unrest. Number 3. Thailand's economy, driven by tourism, exports, and agriculture, is closely linked to the U.S., its major trading partner. The tourism industry, which accounts for a substantial portion of Thailand's GDP, would suffer heavily as American tourists cut back on international travel during a recession. Similarly, Thailand's export sector, including electronics, textiles, and agricultural products, would face declining demand from U.S. businesses and consumers. The ripple effects would lead to factory closures, job losses, and reduced incomes, particularly in rural areas dependent on agriculture. Thailand's financial markets, which are interconnected with global capital flows, could see volatility as U.S. investors pull back. Additionally, the Thai baht might weaken, raising the cost of imports and increasing inflation. The government would likely need to intervene with stimulus packages, but public debt levels might limit its ability to act decisively. Social inequality, already a pressing issue, could worsen as economic hardships deepen, leading to potential political unrest. Number 2. South Africa's economy is heavily reliant on trade with the U.S., particularly for minerals and precious metals like gold and platinum. A U.S. recession would lower global demand for these commodities, causing prices to plummet and reducing South Africa's export earnings. This would have a cascading effect on the mining sector, leading to job losses and declining investments. Furthermore, the country's financial markets are closely tied to global trends, and a downturn in the U.S. would likely result in significant market volatility and capital outflows. South Africa's tourism industry, which attracts a significant number of American visitors, would also take a hit, further straining the economy. Rising unemployment and inflation would exacerbate social tensions, increasing the likelihood of strikes and protests. The government's ability to respond would be constrained by its already high debt levels and budget deficits. While South Africa has weathered past global recessions, its reliance on U.S. trade and investment makes it particularly vulnerable to economic disruptions. Number 1. South Korea's export-driven economy is deeply intertwined with the U.S., its second-largest trading partner. Key industries such as electronics, automobiles, and semiconductors rely heavily on American consumers and companies. A recession in the U.S. would sharply reduce demand for these products, leading to declining revenues for South Korean companies and potential layoffs. Additionally, South Korea's stock market is highly sensitive to global economic trends, and a U.S. downturn would likely trigger significant volatility. Beyond trade, South Korea's financial institutions are also exposed to U.S. markets, and a recession could lead to tighter credit conditions and slower economic growth. The South Korean won might weaken, driving up the cost of imports and adding inflationary pressures. The government would likely need to implement stimulus measures, but the already high levels of household debt in South Korea could make recovery more challenging. The U.S. economy is a cornerstone of global stability, and a recession would have far-reaching consequences. While these 10 countries face significant risks, it's a reminder of how interconnected our world is. Preparation and diversification are key to resilience in a globalized economy. Which of these countries surprised you the most? Share your thoughts in the comments, and don't forget to like, subscribe, and hit the bell icon for more in-depth analyses.